So obviously, I'm sure you've got questions too about this, right? Like we've been getting questions, myself and Artie, about how the exactly the growth and inflation regime map is supposed to be read and what exactly it's calculating. And I think we could summarize this in a good podcast, a short, absorbable piece of content. So those that maybe are new or have lost touch with the models along the way, want to get a refresher, and they can watch this and kind of catch up to speed. So, sure. Well, when we look at this, what do you think from a listener's perspective is probably the most confusing thing on this page right here?
A lot of questions that we get is how is the inflation index and growth index calculated? Um, Unfortunately, we cannot divulge that. That's like
Yeah,
literally our
yeah.
bread and butter for having a 48% compound annual growth rate. So we're not going to divulge that. But literally, all you need is the outputs of those indexes, which we do provide. And this is also very forward looking. It's not something that where the stock market drops 10%, then oh shit, all of a sudden we're in deflation. Now this thing usually flips before those things happen, as we saw recently. We flipped to deflation July 2nd, and that's when we pivoted over to bonds. So
That's a good point though. I don't want me to cut you off there, but we pivoted to risk off, right? So we're in deflation now, which is what Artie meant to say. But in ultimately we flipped the risk off line. And for those that are listening and maybe not watching, open up the screen right now and take a look at the screen here. This way you can get a good idea of what this is and you have a better understanding. This zero line, the horizontal line, think of this as the risk line in the sand. Anything printing below this horizontal line is going to be risk off. So anything above the zero line is or horizontal line, risk on, positive for risk assets. Anything below, risk off, negative for risk assets. And to
simple
clarify,
to simplify that even more, when it's risk off, tech stocks, get out of them. Bitcoin, get out of it. All crypto, get out of it. Bonds are where you want to be. Safe assets are where you want to be. Even dividend companies, healthcare, that's where you want to be. And we even show that in the quant deck as well, what assets perform best in which regimes. So it's as we try to make it as simple as possible to follow along. But at the end of the day, risk on, you want to be in tech stocks. You want to be in Bitcoin. That's when shitcoins moon. That's when you do it. That it always happens in risk on regimes. That's when shitcoins do well. That's when pump and dumps go off. That's when Zach Morris does the best. Those kind of people to get those small cap pump and dumps. That stuff never happens in risk off. So if those are the kind of things you trade, that's what you got to look out for: risk on or risk off.
yeah, notice the entire. So to follow up with what you just said there, Artie, like we had this entire meme coin run in crypto this last, the first 2 quarters of the year, right? It was mania, meme coin mania. Solana was eating everyone's lunch in terms of transactions, and it was just it was the hype chain, right? So and notice that happened. That didn't happen when the system was printing risk off. That happened at the highest points in risk on, right? So if you want, if to really think about it, you can think about it like this: expansion, risk on, moderate; inflation, hyper risk on; stagflation, risk off, moderate; deflation, hyper risk off. So that's kind of how you can go through the cycles here, and you're going to follow. If you have the report, this is updated daily in on the website and in the Discord. You could see here that the filled in square, so the solid square, is the latest print. We're recording this a little earlier to prevent leakage of live models because our members pay a good price to get access to this stuff, and we don't want to just freely distribute this to everyone. But ultimately, this gets updated every single trading day, so everyone can see where we just printed in the system and have an idea in terms of where risk is going. And you kind of have a summary, a historical summary of both of these components, the growth and inflation components on the left here, and it gives you an overview of how strong and what trend they are moving in. So when they're both bearish trend and they're both pretty negative, you're going to obviously, bearish trend negative, you're going to have negative growth. So if you look at inflation here, you have negative inflation, you're going to have excuse me, negative growth, and you're going to have negative inflation over here. So you're going to be in deflation. But I think that the most important thing that the service level reader needs to pay attention to is just the risk condition. You don't need to pay too much attention to deflation or stagflation, or if it's inflation or expansion. The key line here is, are you above the horizontal line? Is it risk on or risk off? And we make it pretty easy. In the top right here, we indicate where we are. We have it listed live right here for you. And this component here, this classifier for the regime classifier, risk on or risk off, is going to be a significant input in the models we're going to show you in a second. So let's explore how this all gets put together into something that's actionable and everybody can use. So if we scroll down to the model section, the first thing you're going to see is the RQF. This is the Radar Quant Fund. And Artie, do you want to give us a little rundown on what this does and exactly what the aim of this specific portfolio is to
So,
accomplish?
the aim of the portfolio is massive compounding, leverage, basically everything that any investment professional will tell you to stay the fuck away from. That's what we do. Just because our system is so powerful that we are able to lever up without risking those massive drawdowns that can happen when you're using triple leverage. So, the RQF comprises of three different portfolios that we run. Our main portfolio, Aries, which is our bread and butter, that's 60% of our total portfolio. And that just fluctuates between long the NASDAQ, triple leverage, or long bonds, triple leverage. Whereas right now we're long bonds, TMF, that's the ETF we use, or cash. There are periods where it decides it's not a good environment for holding stocks or bonds, and it's time to just stay in cash, which we had a pretty lengthy cash period in 2022 when we had that stagflation where both bonds and equities dropped. And the system foresaw that, and we were able to sidestep it with cash. Next, we have Astrius, which is our Bitcoin model, and that basically just longs Bitcoin or goes cash. And it's very important with Bitcoin because it does have those massive drawdowns that don't feel too good holding through. And the aim isn't to really outperform Bitcoin because Bitcoin is pretty difficult to outperform. It's a pretty insane asset to hold. The aim is of that one to match the performance of Bitcoin as closely as possible while going into cash and sidestepping any drawdowns. And then Hercules is our short volatility model. It just longs SVIX, which is inverse volatility, and tries to sidestep as many drawdowns as possible and reap in as much of that growth that's in short volatility. And it's pretty good at that. We were able to avoid basically every single major drawdown. That portfolio does have drawdowns, which is why at the end of the day, Astrius and Hercules are both only 20% of our total portfolio. But they do have that growth rate to really back up the drawdowns that come with them. But bread and butter is Aries, and so RQF is a combination of the three of these, and that's how we're able to get that 48% compounded growth rate that you see in our reports and that we post on Twitter all the time.
I think we're going to do a quick shallow overview of each of those models that you just explained there, and kind of just touch on what exactly is going on and how a user or a reader can interpret what's going on here. So as Artie just explained here, you have the overview, the hypothetical RQF breakdown. Again, this is not investment advice. This is simply a hypothetical model. What you do with this is up to you. That's in your hands. You should not be blindly following anything on this report. This is a hypothetical model. It's for educational purposes only. Anyways, let's go back into what these models do. So Aries, stocks and bonds, right? You're going to see on here a hypothetical breakdown. It's going to show you the current target, which is always going to be 60, 20, 20. and then where the current target has moved to because of the underlying. So you're going to see here on the reserve section that the reserves fluctuate based on how the models are doing. Because Aries bonds right now are up in the RQF, the NAV is going to lift in the Aries section. Every quarter, at the end of every quarter, the last trading day, we have a rebalance where this reserve gets reset back to 60. So if, for example, bonds are really outperforming in a quarter or Bitcoin's really outperforming in a quarter, at the end of the quarter, everything gets rebalanced back to 60, 20, 20. Now, this over here will tell you how much of the current portfolio is actually active. So we started the quarter with 60% bonds. It moved up to 65 because bonds have moved up, and 65% of that 65 allocation is active, meaning we are maximum long bonds within the model's parameters at the moment. Now let's speak about the model parameters, because some of you guys might just not have understood a thing that I said, and I think this next step will make it real clear in terms of understanding what is going on here. So let's start with Aries. This is our stock and bond model, either stocks, bonds, or cash. Very simple explanation here on the right in terms of what is being done here to absorb and analyze the triggers. Now, it's listed here as unleveraged because we wanted to give a base foundation. If you're going to follow Aries, again, listed here as 3x, simply put, you're going to just swap out QQQ for TQQQ and TLT for TMF. All the other stuff stays the same. So the conditions to long equities, the first condition is a risk-on regime. So remember that thing we spoke about earlier, that's that horizontal line in the system here? If the system is printing above this zero line, we are in a risk-on regime. So that is step one. And you can see the regime currently at the top right here. So we are in a risk-off regime. So step one is negated. Simple negation here. Okay. Because it's an all or none model, because we're not in a risk-on regime, we are going to completely invalidate equities at the moment. We're going to move down to bonds. Okay. Bonds look for a risk-off regime. We are, in fact, in a risk-off regime. Great. Okay. But the next parameter, remember, all or none, bonds, the bond index must be bullish trend. And you can get a pretty close representation of this by just going to your trading view, typing in TLT on DDAP, which is our trading view script that's given to all of our subscribers when they subscribe. If you look at DDAP with dividends adjusted for TLT, you will be able to see a pretty close representation of what the current trend is. Right now, bonds are bullish trend. We list the live trends in here as well for those that just want to look at the report. So current trend, bullish trend. So we have a risk-off regime, a bullish trend, check, check, great. Now the next step is the second layer MR growth index below or above 0%? Or below 0 or above 0? Basically, is it more negative than 0 or is it just 0, right? And the key there is it's a mouthful. Just keep it very simple. You look one step below, and this goes for both the top and the bottom, second layer MR growth index. So you have that right here, negative 76%. It's less than 0. For it to be a long equities confirming trigger, it has to be above 0. So you're going to simply look at this and say, okay, we're in risk off. Bonds are bullish trend. We are less than 0. Good. We get 100% size. Now, some of you are listening to this and like, what the hell did I just listen to? This is so confusing. Don't worry, bros. We made this real simple. In the top right corner, you literally see the size. All this is just to understand what rules are going on. But if, let's just say it is going to, the growth index is 0, so it's not below 0, it's just 0. If this growth index, the second layer growth index, is not less than 0 in a risk-off regime, as it states right here in the last line, it's going to be a 25% allocation. Now, in a risk-on regime, if the second layer growth index is 0, it's not above 0, it's going to be a 25% allocation. So Aries is going to have either 100 or a 25% allocation. Now, again, these rules here are just for those that want to kind of have an understanding of what is moving the rules and how. Laid out real simple in the top right corner. You don't have to do much thinking or much understanding, or you don't have to squeeze any brain cells. You can just look right up here. The position, TMF, size 100% at the moment. As the size changes, these will be dynamic and update in real time. Now we go down to Astrius, a bit simpler and more low touch than Aries. And this is, as already said, the goal of this model is to sidestep a lot of the Bitcoin drawdowns while trying to keep a lot of the gains. So if you can look here in the last 5 years, we actually are outperforming Bitcoin on a trailing 5 year. But if we scroll down, you'll see that we're pretty much in line with Bitcoin in terms of the inception since 2016. But the difference is our max drawdown is 50%. Our average drawdown is 22%. Meanwhile, Bitcoin's max drawdown is 83%, and Bitcoin's average drawdown is 38%. So we lose a little CAGR here. We lose a little total return, but we have much better drawdown control, and we have pretty much near similar ending results. So that's why that's what we use
Basically,
Astraeus
the
for.
goal of Astraeus is your health is your wealth. You don't want to go through that
Pretty much.
stress of going through the drawdowns of Bitcoin. That's what it's all about, is, just low stress while still being able to not have FOMO that you're missing out on Bitcoin.
Right. So, anyways, the Bitcoin rules, the Astraeus rules, pretty simple, not as complicated as Aries, and a little bit different. If it's a risk-on regime, it will long 60% of the model. Okay. And if Bitcoin is not bearish trend, meaning if it's neutral or bullish trend, it will go long 40%. So very simple explainer right here. Current regime, risk off. Okay, so that takes 60% of the weighting off the table. Current trend, bearish trend. Okay, so the position size is 0. It is flat. We are still in risk off as we have previously explained. So therefore, no Bitcoin position. We go back up, or no Astraeus position. We go back up to the RQF, Astraeus Bitcoin model, right? 0. Makes sense. The final one is the Hercules one. This is the short vol one. And this is actually quite interesting because we just had some short vol implosion in the last couple of weeks here with this whole JPY, or Japanese yen, carry unwind. And if you look at the trailing 5-year chart here of the model on the bottom, you're going to see the short vol index is the gray line. Hercules is the orange line. And what do you notice? This gray line massively crashes here. The orange line stays still. Why is that? That's because Hercules has been flat for some time. It closed out near the top end of the short volatility range that we saw before the implosion. Since then, short vol imploded. VIX is up quite a bit, and now we are slowly reversing, meaning short vol is slowly starting to pick back up. But as you can see here, look back in 2020 in the COVID crash, our short vol model even got out of that whole fiasco. So how do you read this model? Pretty much similar to the other ones. You can always look in the top right, see flat 0%. And the defining factors here are, again, risk on regime is 25% of the model. The growth strength, the growth index strength must be over 0. That's 25% of the model. And what that is telling you is, if we go back to the original growth strength here, not the second layer, which was explained in the Aries section, back to the first page, the growth strength has to be above 0. And we are obviously not. That means this blue dot has to be above the 0 line. It cannot be on the 0 line, the horizontal line. It has to be above. It is well below. So that is invalidated, right? So we also have that displayed down here, so you don't have to move around the report. Very simple. Look down here, current MR growth strength, -80. Great. Now the current MR liquidity conditions index. This is the LCI, the liquidities conditions that we post on X all the time. And that's brought into here. You're not going to see the LCI anywhere else but this report. And that's on page, I think, 5. Yes, page 5. This is the liquidity conditions index. And as long as this is below the 0 line, anything puke or turbo puke, that is going to hold a negative reading here for short vol. So the last and final step for Hercules is going to be a liquidity index that must be positive as a 50% weighting. Since we are in a negative liquidity environment, 50% of the models off the table, we're in a risk off regime, 25% of the models off the table. And because we are in risk off, the growth index strength is obviously below 0. We are in a 0% size flat short vol environment. And we've seen short vol implode multiple times in these environments where we sidestep them and we've performed quite well. Now, like you said already at the beginning, look, these Bitcoin and these short vol models have drawdowns. This is not 50% on Astrius for Bitcoin and 41% for Hercules on short vol. So these are not minor drawdowns, which is why they're weighted at 20% of the portfolio for each of them. But as you can see here, it's 41% compared to being short vol and having a 91% drawdown, which is pretty much you cannot recover from that. That's financial destruction. Okay, drawing down 91%.
Yeah. Also, I want to mention a reason why we included Hercules in the RQF is for those times where the stock market doesn't really move. We saw that for quite some time in the Obama era where prices go sideways for a year, even 2 years. It's happened in the past, and with having this short volatility model during those periods, it's kind of like you're raking in some returns while equities stay sideways, because short vol, as long as volatility stays suppressed during those sideways periods, the short vol index is going to continue higher, and that CAGR really comes into play during those times and helps us outperform the market.
And what you'll even notice here, believe it or not, in the observable period since 2005, the Hercules index has a far superior CAGR than the short vol index, nearly 10 percentage points higher. But it also has a superior CAGR to the S&P 500. Matter of fact, it draws down less than the S&P 500 in that same time frame. It has wider average drawdowns, again, because it's going to be volatile. And we're talking about short vol here. It is volatile, right? So it's going to have much wider average. It's going to have a deeper average drawdown because it's just more volatile. But to add on 3 or 4 percentage points on the average drawdown and have a CAGR that is, more than double the performance, I think is, in our opinion, is worth the add-on into RQF. So now that you guys kind of have a understanding of the components in RQF, basically a guide as to what is going on, I want to go and end this discussion back on the RQF slide, because we've just given you the explanation on all these 3 components. Now you understand that they're pieced together like Legos in one big portfolio. So we have 3 models that are stitched together to make one portfolio. And we believe this portfolio is far superior than pretty much anything you're going to find on X, on FinTwit, in terms of visibility into what you guys are seeing, everything, and the transparency of all this and how it's executed. Everything is posted real time. Trades are executed once into the close on the trade days. So if a model triggers, the order will be entered simply into the close of the day following this trigger. So if the report were to be updated, say tonight on a trading day, call it today, Monday, we would be trading into Tuesday's close tomorrow. So it's very clear. There's not a million different trades in a day. You're not going to get lost in wild trade notifications. It's pretty simple, pretty smooth, and it's really low touch. That's the goal of RQF, is to compound without confusion. So think of it like an ease to alpha ratio. Like, how easy can you make as much alpha as possible? I think that's what RQF really strives at. So the ability to minimal effort, maximum alpha. I don't think you're going to find a better trade-off than that. And I think that's where we can end this podcast. Please feel free to share this with your friends. Help us get out there. Help us grow. And if you know anyone that's in need of a 48% CAGR and a possible exit from the 9 to 5 down the road, this podcast is probably for them. If you have any questions whatsoever, feel free to reach out to us on X at the Market Radar, or go to our website at market-radar.com.